Most people look at Home Depot and Lowe's and see orange versus blue. I see a $150 billion game of high-stakes poker. While the world was watching inflation, these two giants just made a bet so big, it could either build the future of American housing or leave a crater in their balance sheets. Welcome to the 2026 Strategic Divergence. Let's see who's actually holding the aces. Here's the reality. The American housing market isn't just slow, it's frozen solid. Nobody is moving because everyone is locked into those tiny 3% mortgage rates from years ago. When people don't move, they don't buy new houses. But, and this is the hook, they still need to fix the leaky roof or the 1990s kitchen. We're shifting from buy and move to repair and stay. The arena has changed from the suburbs to the backyard. But growing in a frozen market is expensive, really expensive. These companies have been on a shopping spree, buying up smaller competitors like they're on a Black Friday bender. The result? Their efficiency, what we call ROIC, just dropped by 560 basis points. In plain English, for every dollar they put in, they're getting back a lot less than they used to. It's like buying a Ferrari to deliver pizzas. It looks cool, but the math is starting to hurt. Now, let's talk about the invisible war: supply chains. If you think this is just about shipping boxes, you're missing the entire 2026 story. It's about who survives the next trade storm. Look at the map. Home Depot is playing risk on a global scale. They've got outposts from Vietnam to Turkey. They're diversified. Lowe's? They've put a lot of eggs in two baskets, China and Mexico. In a world of shifting tariffs and trade wars, Home Depot has a global shield, while Lowe's is standing in the rain with a very small umbrella. In 2026, being resilient isn't just a buzzword, it's your profit insurance. If a port closes or a tariff spikes, Home Depot can just pivot to their factory in Poland. Lowe's is stuck waiting for a ship that might never come. As we say at HDIN, diversification is the new margin. Numbers don't lie. Look at this gap. Home Depot's new acquisitions are bringing in over $12 billion. Lowe's? Barely over $2 billion. It's like one guy bought a professional construction firm while the other bought a local hardware store. Home Depot isn't just selling hammers anymore. They're owning the entire construction site. Here's the ouch moment. Home Depot's new toys are already making money, $316 million in profit. Lowe's new units? They're actually losing $70 million. They're paying to stay in the game, while Home Depot is already getting paid. It turns out, integrating a multi-billion-dollar company is harder than assembling IKEA furniture. Both companies are obsessed with AI. Home Depot has eyes in the ceiling, computer vision that tells them exactly when they're out of light bulbs. Lowe's has a brain that predicts what you'll buy before you even know you need it. They aren't retailers anymore. They're data companies that happen to sell plywood. Let's look at the people. Every single Home Depot employee generates about $348,000 in sales. That's enough to buy a nice house in the Midwest, per employee. Lowe's is trailing behind. Why? Because Home Depot focuses on the pros. The contractors who buy $10,000 of lumber at once, not the guy buying one succulent and a candle. This is the killer app. A contractor can walk in, scan a blueprint, and Home Depot's AI tells them exactly how many nails, boards, and shingles they need. It turns a 3-hour job into a 3-second click. Once a pro starts using this, they are never switching to Lowe's. It's the ultimate sticky product. Let's check the cookie jar, the cash flow. Surprisingly, Lowe's is actually better at turning sales into cold, hard cash right now. They've been brutal about cleaning out their inventory. They might be smaller, but their wallet is very liquid. In a recession, cash is the only thing that keeps the lights on. Time for a reality check. There's a hole-in-the-pocket risk here. Home Depot uses an AI-based system to value their inventory. It's smart, but it's also a black box. If the AI gets it wrong, those profits could vanish overnight. Lowe's uses the old-school way. Transparent, but boring. One is a high-tech gamble. The other is a safe bet. If you take one thing away from this, 2026 is the year of supply chain sovereignty. In this economy, it's not about who has the best store. It's about who owns the factory and the ship. So the winner? For 2026, it's Home Depot. They've built a fortress around the professional contractor and a global shield around their products. Lowe's is fighting hard, but they're still in the, quote, integration tunnel. If you're betting on the future of the American home, follow the orange apron. Got questions? Drop them in the comments. And if you want the full-page deep dive on the home improvement sector, head over to HDINResearch.com or shoot us an email. We do the math so you don't have to. See you in the next one.